5 years ago, my portfolio looks way different from what it is right now. I focus more on dividends, which at the time I thought it was the best kind of investing I want to follow. But that portfolio is also what held me back. In today's Invest With Me video, we'll talk about why I changed my investing style from safe and stable to a more blend of value and growth. If you're new here, my name is Ron and welcome to Pinoy Stock Investor. But before we start, let me know down in the comments what kind of investing strategy are you currently following right now. It'll be really interesting to know. Okay, let's start with market check. All right. Right now, the S&P 500 is down by 0.90% and Dow Jones is down by 0.72%. QQQ is down by 1.04%. And looking at our portfolio, currently it's down by 0.31%, which is a bit, when I say a bit higher, which is performing better compared to the S&P 500, which is down by 0.90%. Going to our taxable account, currently it is down by 0.02%. Okay. Yeah. And for today, we're going to invest $100 to the portfolio. Okay. Let's plug in the $100 to the Google Sheet. And okay. Right here, $100. And over here, it shows that in industrials, we're going to invest $10. For financial services, we're going to invest $10.5. For communication services, we're going to invest $15 per company. And in technology, we're going to invest $13. These guides are actually just a guide, and I still do my own preference when I do my investing. It's just depending on how I feel on today, like how much am I going to invest. But generally, these are the kind of amount. Whenever I plugged in the numbers in this Google Sheet, it acts as a budget to each of the companies that I'm going to invest in. And it differs from the weighting, like how much weight I give for each of these sector. Okay. All right. We'll start with Uber. So actually, today we did receive our last dividends from Visa, which is $16.75 of dividends. And it's also going to be invested in today's video. Okay. We're going to start with Uber. All right. Since we're going to invest $10. Okay, $10. And done. That is 0.13 shares of Uber. All right. Next is MasterCard. Okay. We're going to invest $10.5 to MasterCard and buy. All right. That is 0.02 shares of MasterCard. Next, we are going to invest in Google. Okay. So for Google, we have $15. Okay. All right. Right here, we're going to invest $15. Okay. That is 0.049 shares of Google. Okay. So Google actually just started paying dividends. And one of the things that are great in dividends is that they can be a steady stream of income. So dividends provide regular and consistent cash flow to the investor, and it can be used for a living expense, particularly in like when you're in a retirement age. Dividends would be a really great steady stream of income for you. And also, it reduces the volatility of your portfolio. So stocks that pays dividends, they are generally less volatile, like Coke, Pepsi, and those other stable companies, compared to a non-dividend paying companies, because majority of the companies that pays dividends and consistently paying dividends are already matured, and they have their fundamentals down to the T. So they most likely are consistent, and they have or they have less volatility compared to growth stocks, compared to those who are just starting. And they also act as hedge against inflation for investors, because companies with the history of increasing their dividends, like those dividend aristocrats and dividend kings, they can be used to prevent or fight the rising cost of living in your retirement age. Or I mean, even now, if you focus on income investing right now, definitely you are able to afford those kinds of expenses that regular people who doesn't have investments can't afford. And those companies who pays dividends, generally majority of them have a really great financial health. So companies that pays dividends consistently and growing their dividends are often established companies. Not all, but majority of them. They are matured and they are financially sound. Again, not all. You should still do your research, which kind of companies are matured and which kind of companies have the means to pay this consistently growing dividends. Okay, the next company that we're going to invest in is Meta. So today for Meta, we are going to invest $25. Okay. So Meta, put there. All right, $25 is 0.038 shares of Meta. Okay, next we are going to invest in Apple. All right, so we go open Apple and then trade buy. Okay, we're going to invest $15 in Apple. $15. There you go. That is 0.056 shares of Apple. Okay, next we are going to invest in Microsoft on our list. Microsoft. Okay, there we have it. Microsoft, we are going to invest $15 to Microsoft. Okay, and $15 is 0.037 shares of Microsoft. So these three companies, Meta, Apple, and Microsoft, they are all dividend paying companies. And when they pay me dividends, it's actually a taxable event, meaning since these companies are in my taxable account, whenever I receive these dividends, I get taxed on it. They don't deduct the tax right then, but at some point here in the States, when there's this thing that they call tax season, and in tax season, that's when you pay those dividends. That's when you pay taxes to the dividends that you receive. So dividends are often seen as free money, but in reality, if these companies are in your taxable account, like what I have right now, you have a mandatory taxable event that's happening in your portfolio. So you got to pay taxes. And these taxes act as a drag or a anchor that slows you down when it comes to investing. So the higher dividends that you have or the higher dividends that you receive, the higher the taxes that you're going to pay. Of course, depending on your tax bracket, you have different percentage that you got to pay. And also depends on how you're doing your taxes. But the clear thing is that you have to pay taxes from all those dividends. So the higher dividends that you receive, the higher taxes you got to pay. And like what we mentioned earlier, it slows you down. So if we're going to compare two things to see the difference on how it works, let's compare VOO and VYM. So long-term performance, looking at the total returns in dividends with the dividends reinvested, roughly from 2010 to 2026, VOO has outperformed VYM, and VOO roughly produced 14% return, annual return, and VYM is 12.19%. Now, those dividend income that VYM yielded, they have a higher, because VYM have a higher yield compared to VOO. So VYM have like 2.2% to 2.9% compared to VOO's 1.1% to 1.5%. So it shows that VYM has a higher yield in dividends, which also comes with more tax annually if it's not in your IRA, okay? So the reality is that every dividend payout becomes a leak in your compounding bucket. So it's like, it's like your snowball. Every time your snowball is rolling, there's a small snow pieces that are coming off because you're paying taxes. And instead of you being able to keep more, because that's the goal, to keep more of all the earnings that you get. That is one of the things that builds your wealth. The more you keep on your money, on your savings, on your income, the faster your wealth grows. But if you have to pay higher taxes, the more income you receive, it acts as a drag to the growth of your wealth. Okay. So it also did limit my choice of companies back then, because back then I used to look for dividend paying companies. If I want to hold companies that are dividend paying, so if they're not paying dividends, they're not in my list of companies that I want to invest in. So companies like Berkshire Hathaway and Amazon back then were not on my list. But of course, as time goes by, I started learning more about the companies. I started understanding how investing works even better. And I saw that investing in these companies is not a loss for me. So I started investing in Berkshire Hathaway and Amazon. Okay, speaking of, we can start investing in them right now. So the next company that we're going to invest is Berkshire Hathaway. and we are going to invest $10 to Berkshire Hathaway. Actually, 10.98 right now. Okay, and that is 0.022 shares of Berkshire Hathaway. Okay, next is Amazon. Okay, we're going to invest in Amazon. So we have a total of $16.38 in our investing budget. And we're going to put everything in Amazon. 16.38 is 0.078 shares of Amazon. Okay. So, you know that feeling when you receive your paycheck, right? Or when you look at your notification and it says that you receive your paycheck. It's really great. That feels really great. It's like when what they said, like it hits you with a lot of dopamine in your brain. Okay. So dividend is, or when back then, when I received all these dividend payments, when I see the notification on my phone that, oh, you receive a dividends from this company, you receive a dividends from this company, they would pile up on my notification, and I would feel really great about it. But in reality, those notifications that I received is a hit of dopamine, so that's why it feels amazing. But when you zoom out, the companies that I've invested in back then, when you look at their trajectory on the growth of the company, or the appreciation of the company, or price appreciation of the stock, or when you look at the company itself, actually, they never really invested in growth or making the company grow. They were just performing as is to maintain and to sustain not to sustain the dividends, but more like to sustain their whatever's working in them. So one of the companies that I was holding on, that I was invested in back then, was Stag. And Stag is a real estate company, and it's a REIT. So you don't really expect extreme growth in a REIT company, because they serve as a income investment for if you don't want to invest in real property, and you want to invest, but you still want to have exposure in real estate. So at least that's what I've learned. But in reality, when I invested in Stag, I was hoping for growth, and I was hoping for more besides the dividends that I'm receiving. But since they are paying real dividends, I'm receiving these paychecks monthly, and seeing them, it makes it so that I was blinded to the fact that my principal investment in Stag is not going anywhere, and sometimes it would dip lower, and I would say that it's okay, because as long as I'm still receiving the dividends. So this feeling can blind you to the fact that your portfolio is stagnant. And if you're trying to build wealth, it doesn't come from small checks. It's built on massive jumps in net worth coming from owning companies and assets that are appreciating in value. And for years, I work hard to pick those safe dividend stocks. But I could have just invested in the S&P 500. I don't know, just pour all my money in the S&P 500, and it would have performed better. I would have a better stats today if I just did that when I started, while I'm building my education about stock investing, education about reading companies, about learning about them, it would have I I'm sure that it would have been a better position for me if I put all my money in the S&P 500 back then, which I did. And today I'm happy to say that all of my IRAs are in VOO in the S&P 500. They're just there, sitting there. I would add to them from time to time, and I'm just going to buy VOO. I'm just going to increase my position in VOO. Now, my taxable account is a different kind of story, and would I earn better if I just keep it in the S&P 500? Probably, but I still want to do my own thing, and I still want to invest in companies that I'm seeing more growth in the future. So I have this portfolio, and if I would say something to myself back then, I would say, if your safe strategy is underperforming compared to the most basic benchmark like the S&P 500, then your strategy isn't safe. It's expensive. You're paying for peace of mind with lost and without gains. And that's like the opportunity cost for you picking paychecks instead of your capital growth. Maybe not. Picking paychecks instead of understanding and learning more about investing. But then again, dividend portfolio, growth portfolio, hybrid kind of portfolio, balanced kind of portfolio, whatever kind of portfolio you pick, each of them has their own specific use. And each individual, you, me, people around us have like their own preference when it comes to investing. It might be that the young me, because of my uneducatedness when it comes to investing and when it comes to personal finance, I picked safety and stable. So that preference is on the dividend portfolio. And now that I'm learning more about them, I shift my strategy to growth and value investing. And when I'm old and gray, I might not be able to follow all these things and just wanted to have a simple situational or simple income producing assets and shift all of it into a more focused in income kind of portfolio. So it really depends on the person's preference, individual's preference, and the specific use that they need. So for me, investing in income investing was a great start. It taught me a lot of safety, learning and picking stable companies, and importance of consistency. But realizing where I currently stand in my wealth building journey, I am in the early stage of my wealth building accumulation pace. Maybe it's because back then, growing up, I grew up in a household where if you have more income, you are safe for the week. So I have a bias when it comes to income investing back when I was just starting, because that's the safe option. the safe option. But I'm getting there. I'm able to find companies that, and assets actually, that are now growing and building my future. And for long, I don't know. I don't know if I'm going to hold them for that long, or they might be replaced by a different companies. The important thing is that we are invested, and these investments or investments seeds will be the tree that will provide to us in the future. If you get value in this video, don't forget to subscribe and like this video. It's free and will definitely help my channel. I hope you have a great day, and peace.